Hi, everybody. Welcome to Taxwise Talks. My name is Jeff Powell. I'm an advisor and a partner here at Cornerstone Wealth Management. And today I'd like to take some time to introduce Cindy Mears, who is our Director of Tax Services here at Cornerstone. So one of the things that we've heard from clients is they'd like a little more help with taxes and answering their tax questions and tax planning. Now, Cindy also prepares taxes, and so that's a win-win for us at Cornerstone. So a little bit about Cindy. So Cindy has 30 years plus of tax planning and compliance experience. She brings that all to Cornerstone. She's a CPA. And one of the things that really fit in what Cornerstone was looking to do is her approach with her clients. And she's very client-centric, really cares about her clients, and really wants to help them make sure that they make good decisions when they're, planning their taxes. So, and just, the commitment of Cindy and the amount of time that she really puts into this makes it a perfect relationship to work with Cornerstone. So tax planning, some of the benefits of adding that to Cornerstone, it really gives us an integrated solution when we're talking to clients. I know for myself, when I meet with clients, we talk about investments, but then we also talk about estate planning, tax planning, and now we have an expert that actually can come to meetings that we can refer to and call to make sure that we're making the best decisions possible for our clients. It's also efficient, having somebody on staff able to answer those questions. We no longer have to say, please go to your CPA to get an answer, which just makes us more efficient and the relationship that much stronger. It also fit right with our 360-degree approach, right? Being able to address all areas of our clients' financial lives, which is extremely important. And then just personalized service. I've never seen anybody work harder for her clients to make sure that they're well taken care of. And so that was a perfect fit for Cornerstone. So one of the things we did is we created a top 10 list of considerations for taxes. And the first 5 really fit into the Tax Cuts Job Act of 2017. And so Cindy, can you take a little bit of time and kind of walk through these 5 and how it fits into that the Job Act?
Sure. And thank you for that very warm introduction, Jeff. And I've been here since, I guess, last October, and it's definitely been a great decision. I'm really looking forward to what this is going to mean for Cornerstone and for me personally. So getting back to the Tax Cuts and Job Act of 2017, you probably don't really remember a whole lot about that, but it made some very significant changes in some of our tax provisions after that time. What a lot of people don't know is that that is set to sunset at the end of 2015. So all of those provisions that we have become used to over these years will go away. And on January 1 of 2026, we'll revert back to what the law was prior to that time. So a couple of big things to remember is that that act is what brought our estate and gift tax limit up to the large numbers that we know today that have never been this large before. As you may know, it's about 13.6 million per individual today. They estimate that it will now revert back to approximately 7 million per individual on 1/1/26. So in thinking about that, many people are deciding to go ahead and do some gifting over the next 2 years to move those assets from their estate. Another thing to consider would be doing some front loading of your charitable contributions and getting that money out of your estate as well. Not only do you get the tax deduction, but of course you're moving it from your estate, and you would do that through a donor advised fund because you can front load the contributions there. And also, perhaps setting up some charitable trust. Think about whether that's something that you would like to do to leave a legacy there. Another thing that many people don't realize is that the rates will revert back to the rates that were in existence pre-17. As you look at what the projected rates are, I'll just give you some examples. The 12% bracket will be 15%, 22 will be 25, 24 will be 28, etc., until you get to the top bracket, which is now 37, and that will now be 39.6. Sometimes that doesn't sound like some big increases, but 3% in every bracket is going to make a pretty big difference in people's taxes. And, is that high compared to our nation's history? Well, in 1964, before Jeff was born, the marginal rate was 70%. At the end of World War II, the actual highest marginal rate was 90% to pay for the war. So do we know for sure what the rates will be in 2026? No, we don't. We just know that the other rates will sunset. They will at least be that high. And of course, they could even be higher. So when you think about rates going up, you want to accelerate your income into the next 2 years. One way would be to do some Roth conversions, take the money out of a 401k to put it in an IRA, and then, or if you have some existing IRAs, go ahead and make some Roth conversions in the next 2 years. Accelerate that income while we do know that rates are lower than they are expected to be. Another thing that's a small item, a lot of people have become accustomed to doing the standard deduction because, as you know, they capped back then that $10,000 was the cap on state and local tax deduction, which was very unfortunate for those who live in California and New York, whose real estate taxes are that high. And so that's going to change too. It will revert back to the law was that you deducted 100% of all of your state and local taxes, income taxes, real estate, personal property taxes. So many people may begin to itemize again. And so that's something to be thinking about and preparing for. And finally, I wish I could get a show of hands of how many people in the audience were subject to the alt-min tax before 2017. I know for many of my clients, it became more and more and more of them every year. And of course, everybody's like, what is this? What is alt-min? Well, obviously, we don't want to talk about that in great detail today. But those thresholds had not been changed for the exemption of that for many, many, many years. And so as people's wealth increased, then more and more people were subject to alt-min. The thresholds were significantly increased after this Jobs and Tax Cuts and Jobs Act, going back to those old thresholds on 1/1/26. So many, many people will then again be subject to the alt-min tax.
Okay.
Okay.
So let's talk about the next 5, and these relate to the Secure Act of 2022. So can you elaborate a little bit on these, please?
Okay, picked out just a few things here. Many of you are familiar with a qualified charitable distribution that you give contributions directly from your IRA where you have a required withdrawal. They have increased the threshold for that for 2024 to $105,000. Previously, it's been $100,000 for years, and they are now going to be indexing that for inflation. So that's some good news. And then also, they're going to allow you to carve out some of that. If you want to put some of that money into a charitable trust, you are now able to do that as opposed to just giving it to an outright charity. Another thing that's interesting, the qualifying longevity annuity contract. Your advisor can certainly tell you more about that. They have broadened the amount of money that you can put into these contracts, and also a couple of other changes with regards to that, catching up on some contributions and things. So if you're interested in that, that's carving out a portion of your IRA that would fund this annuity and therefore reduces your required minimum distributions during your expected life expectancy. And then one that's really fun to me, and I wish that someone had done for me, if you have some old 529 plans that you are not going to have to use because the children or the grandchildren did not need all of the money, then you can, after you've had the accounts for 15 years, they can now be rolled to a Roth IRA account for that beneficiary, which is really a wonderful thing. And finally, one of the most important things, and where I have seen so many mistakes in my lifetime, is that bullet point number 4, changing, your beneficiaries on your retirement plans and your IRAs, critically important. We don't have the time to talk about all the mistakes I've seen in my lifetime, but for instance, I've seen someone, not my client, thank the Lord, that was divorced and later remarried, never changed his beneficiary. And of course, the ex-wife got the money. So that's the bottom line is what you need to know is that when you have a life-changing event, one of the very first things you do is make sure you've got the beneficiaries in place that you want to be there. Just this week, I had a client come in 2 days ago. I turned over his form and it had his beneficiary designations there. One was his wife, and one with the second contingent was his daughter. His wife passed away 2 years ago. Okay, everybody says, well, that's fine. He's got a contingent there. But what happens if his daughter is accidentally killed in a car accident this afternoon? He doesn't really realize that those were never changed. 2 years later, he passes away. Therefore, there is no beneficiary on that account. It means the estate is the beneficiary, and that's not a very good choice. So, I said to him, your homework today is to go home and get that taken care of. What are the odds of that happening? Obviously very slim, but when it happens to you, the odds don't matter. Finally, one other idea that's really for people who may have a consulting business or they're a sole proprietor, they have changed the rules for this year so that you can actually, if you did not establish a solo 401k plan, you can go ahead and do that now. Even though you did not make deferrals into that plan, you can do those now between now and April 15th. So that's some really good planning for someone who has a consulting business and has a separate sole proprietorship on a Schedule C.
Okay.
That's it.
Wonderful. So, thank you so much, Cindy, for taking some time out. I know it's tax time, and I know you've been very busy working and getting these returns done. So, please, everybody, reach out to your advisor with questions. We're more than happy to have a conversation, to get in touch with Cindy and answer any questions you have. This is recorded and it is available on our website. So please go to that. And again, if you have questions, please reach out to your advisor.